Imagine a world where anyone, anywhere can invest in real estate, private equity, and financial assets instantly with just a click. A world where finance is fair, open, and accessible 24/7, giving both institutional and retail investors unprecedented liquidity and transparency. This isn't just some distant vision. It's happening right now.
So I think the real world asset trend is basically the big trend that's now going to be driving the majority of net new value into the industry.
RWA and tokenization is the only way for that change to occur.
We're constantly seeing better products, better security, better transparency, better fees, and so on.
Liquidity, liquidity, liquidity. We need the pie to be much, much, much bigger.
I think that the next milestone is to hit collectively to $10 billion, and then $100 billion, and then $1 trillion.
In 5 years, most of the world's assets will be tokenized.
What we're getting to now are real use cases to generate real economic benefit that are hard to look away from.
Good luck going back.
"2025 marks a turning point in tokenization. Regulatory clarity, institutional adoption, and the global frameworks paving the way for the $30 trillion opportunity ahead. So the question is, why now? I'm Baji Illuminati, CEO of Centrifuge, where we are spearheading the global education and adoption of asset tokenization. Join me as we explore insights from industry leaders at Centrifuge's real-world asset summits across Dubai, Austin, Brussels, Singapore, and New York, each capturing a key evolution in the space. Tokenization and the rate of progress are evidently transforming how we think about financial assets. This has become apparent for both institutions and retail investors. Right now, the number of tokenized assets is steadily increasing, but experts say we're only just beginning to scratch the surface. Today, breakthroughs in technology, infrastructure, and adoption mean the pieces are finally falling into place. So, before we get into the real size of the opportunity, what exactly is tokenization and why does it matter right now?
The idea of tokenization is taking an asset that exists in the real world and putting it in the file format of a token. So if you think about assets in the real world, they may be, ones and zeros in a brokerage app, like Robinhood. They may be a PDF document that's a legal agreement. They may be airline miles in in your Delta app. All of these disparate databases track who owns what. And that system is the system we have today. It's intermediated, it's opaque, it is, it's not open and permissionless. It's certainly not programmable. So the idea is, let's take these assets that exist in disparate silos and move them onto a blockchain. And then the benefit from that is you get composability, you get instant settlement, you get transparency.
The way I think about tokenization and the way I think that the smartest people in the space think about tokenization is being able to bring some sort of off-chain asset, whether that be dollars, whether that be money market funds, whether that be a number of other things, making a digital representation of it where the entirety of the contract or the legal side of whatever might exist there is enforced by smart contracts on chain. The benefits of tokenization allows for programmability, it allows for immutability, it allows for interoperability that simply does not exist in traditional financial systems, traditional financial networks.
I think at a high level, it's not just tokenizing an asset for the sake of tokenizing it. I think when we talk about an asset, a lot of the things that we talk about that are being tokenized are financial products, securities. And so a lot of the benefits come not just from tokenizing the end ownership, but really as much as possible, the end-to-end asset management lifecycle. So things like investor onboarding and capital calls and fund disbursements, fund admin, NAV reporting, all of these things to the extent that different institutions and projects can put on chain and implement kind of smart contract logic to make a lot of these historically manual and disparate processes more streamlined and cost effective. that all, collectively makes the tokenization part make sense in my view.
The most significant benefit is, as I said, displacing trust with truth, right? The ability to know for certain that what I'm seeing is in fact what's being represented to me, not having to trust anyone as to its ownership, its composition, its history, the ability to transact bilaterally, the ability to trade without a counterparty intermediation, right? So we can face off bilaterally with no counterparty or settlement risk and trade instantly. And the ability to cross-collateralize with certainty, the ability to support that democratized prime construct where you can effectively have a true security perfection, whether you're borrowing to trade another position or you're borrowing cash against your asset. That's hugely valuable.
What makes RWAs interesting is that you can take traditional assets and you can have them do more when you bring them on chain. And the reason they're able to do more is because they can integrate and be composable with DeFi protocols, whether it's trading venues or borrowing facilities or new ways to program assets. Everything is possible on chain.
It has the benefit that if it's issued as an ERC20 token, that it's automatically compatible with all the DeFi infrastructure that we have been building. And I think that's also why you want to have those real world assets, right? Like I can already today, of course, I can buy stock via my regular broker account, but it's isolated in my bank. I cannot do anything with it. I can buy it, I can hold it, I can sell it. But in DeFi, because now it's an ERC20 token, I can use it in the entire DeFi ecosystem, hopefully. That allows me to have much more utility. I can borrow against it. I can do whatever I want with it. And that is something that you can simply not do with your bank account.
You get composability, you get instant settlement, you get transparency. You actually can hold the asset sovereignly without sitting, without it being held at a brokerage or custodian or intermediary. And then it's also programmable. So you get to unlock, basically all of the exciting benefits of code, as opposed to just, I would say, like dumb contracts in the real world where you can't really do anything with assets.
Everything that in traditional finance is very, very cumbersome, very, very heavy, very, very time consuming, is just automated on chain. And it's kind of amazing that actually finance hasn't got to this point until now. I feel like it's the last industry to not benefit from from technology and automate processes as a result of technology.
RWAs will change traditional finance, I think, in the speed of settlement. That's a very big one. So right, like today, it often takes days, if not weeks, to settle exotic transactions. There's really no reason for that. If you have a token, you send it, it's settled. You send stable coins, you settle the other side of the transaction. I think that will simplify things tremendously. The fact that today settlement and making the transaction and settling the transaction isn't one step actually means that whenever something goes wrong between those two, it's a lot of work to kind of reconcile and correct these issues.
It solves a problem that I don't see as solvable any other way, which is connecting the globe's investment marketplaces, standardizing the way assets are stored and traded, and allowing for automated market participants. I think it's gonna unlock smaller investment opportunities because of the startup costs that are unavoidable in the traditional system. And I think that's gonna unlock more entrepreneurs. I believe that RWA and tokenization is the only way for that change to occur.
Now we understand the promise and potential of tokenizing real-world assets from both an institutional and retail perspective. But tokenization isn't exactly a new narrative. The idea's been around for a long time and even gained significant mindshare back in 2018. So what has changed?
I think the biggest kind of institutional adoption moment, right, was when BlackRock launched a BUIDL token, a treasury bills product that you can now hold in tokenized form on chain. I think that is the largest asset manager in the world using crypto, actually building a product and actually seeing the success that it had, created a huge wave of interest from other institutions and kind of legitimized this market tremendously.
I think the biggest one is just Larry Fink coming out and saying, hey, we're going to tokenize everything in 2023. I think JP Morgan employs like 300 people in their Onyx division, even though Jamie Dimon is very publicly saying how much he hates crypto. I think the launch of the ETF was more buy-in from the traditional markets. I think the fact that we've now seen real legislation around and rulemaking around stablecoins, and we're here in Europe right now, so MiCA, but also in Japan, digital dollars are now allowed, and we're starting to see that in most jurisdictions. I think those things are kind of an accelerant to the space.
What we're getting to now are real use cases that generate real economic benefit that are hard to look away from. And that's why the banks are starting to lean in. That's why the funds are starting to lean in. And that's why the regulators will lean in, because if there's economic benefit, ultimately that accrues back to the consumer.
So you've seen a lot of different, people starting to have interest in this. It's different than historically, where we had like the STO boom back in 2018, 2019. You're starting to see I think the convergence of the technology being, more applicable and more usable. It's still a long way to go, but it's better this time. Regulatory frameworks that allow these things to be actually tokenized and brought on chain, and just the mind share, and it's all kind of coming together.
I think sometimes people think about crypto or cryptocurrency and RWA as like a zero-sum equation. When cryptos are hot, then RWA is going to be cold, and vice versa. I think maybe that was what has changed since 2018 to today. I think RWA has found a clear space in that ecosystem. And as more infrastructure builds around it and more broader interest comes around it, I think this will form itself properly rather than it being a side stage to cryptocurrency.
What we really have a lot more now is that a lot of these companies that are pursuing license regime after our regulators to get a license to really want to develop real use cases, real financial instruments, tokenized financial instruments, tokenized assets, and create business and liquidity and use cases for the market. And I think that itself has been the biggest movement I've seen so far.
AMA and PwC just published the 6th annual crypto hedge fund report. So that's hedge fund specific, but we found that about a third of the hedge fund respondents were actively tokenizing their product or strongly considering it for the future, which was an uptick from last year's results where it was about 25%. So there's certainly progress. I think the bigger way that it really connects with the broader industry trends that we're seeing is this theme of what is called democratization, or the wider distribution of alternative investment funds to a broader audience.
I think it's really cool that RWA is just innovating, and we're constantly seeing better products, better security, better transparency, better fees, and so on. And then what's happening now is all the major DeFi protocols like Sky and other large DeFi protocols are gaining the flexibility to actually then also allocate into these and take advantage of this kind of innovation in the RWA space.
I think diversification is a big thing. Now a lot of the DeFi opportunities, they're not as diverse that you can actually see on the traditional financial ecosystem. So you have a lot of financial opportunities. You have on-chain cash and through stablecoins and yield opportunities, but you don't have that type of diversification that you can see on more traditional finance. And that's the kind of like a missing piece. So for example, if you want to diversify on-chain, your options is going to off-chain and actually acquiring different kinds of assets that provide that diversification. And bringing that on-chain means that you can actually diversify more easier and more accurately, and even add programmability into that.
All crypto assets are highly correlated today. Stablecoin's the first example of diversification, obviously a way to just simply hold the dollar on-chain. Real world assets or non-crypto native assets, having those on-chain allows people to get exposure to other assets that are either anti-correlated or uncorrelated to their existing crypto holdings. In terms of what that does for the underlying market, I think it's quite simple. It's just the general benefits of why blockchains matter and people should want to use them, which is more transparency, more openness, and more immutability.
So back in the day, the discussion was, you are nice with your public blockchain, but that will not work. It will be private blockchain. There was R3 and other conglomerates with a lot of funding that did go exactly nowhere as expected. And now you have BlackRock coming to Ethereum. And other asset manager, Franklin Templeton, with them 3 as well. So I think this stage, the private blockchain is in the past. We are moving on. There was also discussion of, no, stablecoin will not remain just with a blacklist. It will be KYC, AML all the way, and no one could hold a stablecoin with a big KYC. That was something I heard a lot until 2021. Now with MiCA passing, Société Générale issuing a permissionless stablecoin, good luck going back.
To truly grasp the immense potential of real-world assets, we need to compare where the market stands today with projections for the future. Right now, the vast majority of the world's $600 trillion in traditional assets are managed using outdated systems, manual processes, and spreadsheets. But the change is coming. It's estimated that tokenized assets could grow to $30 trillion by 2030. So where are we today, and how will this evolution unfold?
Right now, real-world assets has surpassed the total value locked in DeFi, which is pretty significant because it's a very small percentage of what can be turned into a real-world asset. My personal view at this point is that real-world assets will surpass the value of crypto, the total value of cryptocurrencies over the next 1 to 3 years. And so I think our industry will end up being defined by both what's in the real-world asset blockchain format and what's in the cryptocurrency format. And this will significantly change how people view our industry and what it fundamentally does. So I think the real-world asset trend is basically the big trend that's now going to be driving the majority of net new value into the industry.
I think we, as I mentioned, we've got into low single-digit billion dollars. I think that the next milestone is to hit collectively to $10 billion, and then $100 billion, and then $1 trillion, right? Because size matters. The more projects out there, the more companies come into the space, the more investors hear about it, the more technology is being developed to make it easier and to make it, provide more utility, as we discussed, and more functionality. So this is, at the end of the day, a factor of volume, right? So the fact that we're now past the first few billion is great, but we need to get to, tens of billions and then eventually to $1 trillion for this industry to really be an important one.
So I think there's a spectrum. So I think about it as there's $600 trillion of assets globally that live off-chain. Those can be roughly divided into 4 major buckets. So stocks, bonds, currencies, and commodities. Most assets globally can be distilled into one of those 4 buckets. I think there's tokenization activity across all of those. So, I would say you're seeing the predominant activity you're seeing on chain right now is tokenization of fixed income products. That can be initially something as simple as a US Treasury, which is I would say the most popular category. It can extend into other types of private credit, so private loans. And outside of the fixed income bucket, you've seen tokenized gold and commodities on chain. You've seen also, interestingly, kind of like tokenized LP stakes or tokenized structured products. And then one of the areas I'm fascinated with is kind of more esoteric, really like long tail assets that don't really have established capital markets that are now being tokenized on chain and finding like an initial place to be traded or financialized. So these are things like collector watches, baseball cards, fine art, farmland, litigation finance claims, carbon credits. These are things that aren't traded through traditional Wall Street infrastructure because it's not worth the time of the bank because there's just the markets aren't big enough for them to make money. But they're kind of, so these assets are now finding critical density on chain, which I actually think is really interesting.
I think broadly the view across the industry is that the supply is a little ahead of the demand. That's not necessarily a problem, right? Whenever there's a new market, that's quite often the case that there's more supply than demand. It's all going to come down to the use cases, the product market fit. So I think it's just that's the trend. These things will eventually get a critical mass. So the more people that are tokenizing assets, the more you can then buy and sell and trade assets across different ledgers in a broad ecosystem. That one I think will provide the opportunity for this sort of hockey stick where things will really take off.
That has to be a big focus. What do we put on chain, and making sure that those assets actually have value inherently, and by putting them on chain we just make them more efficient and more appealing, potentially accessible to a greater number, but their on-chain characteristics should not be their only appeal. If you tokenize shit, you still have shit. To answer the question more directly, what we see now of interest from investors for real-world assets, a lot is around fixed income, actually. There's quite a bit of bonds, work being done on bonds to be tokenized, both state bonds or corporate bonds as well. So that's kind of where we see the most traction currently, but it does remain very, very nascent.
I think more than anything else, we need winners. We need proven investment outcomes that individuals can underwrite and can assess, that demonstrate the value that's possible in the space. I think the industry's done a really nice job in getting organized and having a better articulated message, a more consistent message, certainly in the United States. And so I've been pretty encouraged by this year. It's advanced the dialogue at a national level far beyond where I would have expected. And I think people are becoming much more mature in their style of messaging. So I'm pretty encouraged about it.
Liquidity. Number one is we just need more volume. Today, RWAs, excluding stablecoins and treasuries, are a very small market. We need the pie to be much, much, much bigger. So we're now in the order of magnitude of maybe tens of billions of assets. We need tens of trillions in assets. The first trillion, is hopefully coming in the next 5 to 10 years, but that's pretty far away.
We have not even remotely come close to reaching the scale of the traditional securities markets, which settles and clears quadrillions of assets every year. But it will take us quite a long time to get to the scale of the traditional markets and for that transition to happen.
We don't even know yet what the potential is fully. I think we have first ideas of what RWAs can enable, but when you think of how big the impact will be on the financial system, there's stuff that none of us have really thought of yet, right? And I think when you go towards a 24/7 fully automated financial system that anyone can participate in, that will lead to so many new use cases and ideas and different methodologies.
We're 10% of the HELOC market, let alone of the whole market. But this is going to change because the market's really good about finding efficiency and economic advantage. And we have a big economic advantage using blockchain to originate and trade assets. I think you're going to see a tipping point where there's a massive shift to issuance on chain.
I believe if you invite me back to an interview in 5 years, most of the world's assets will be tokenized. And I think it's a fascinating thing because we only have about 1/3 of the assets in the world that are liquid. So that would include stocks and bonds, paper assets, obviously liquid like cash and things like that. But this piece of real estate, there's art, there's collectibles, there's many, many different things that are in our total portfolio that are illiquid assets. But the world of digital tokenization of real world assets, I think, is upon us.
Real-world assets are no longer just a theoretical concept or a speculative buzzword. They have become an integral part of financial markets, both on-chain and in traditional finance. Institutions and DeFi protocols alike are adopting tokenization at scale, unlocking new efficiencies, liquidity, and use cases. But where is this transformation happening in practice? And how are these innovations reshaping both capital and crypto financial markets?
What I'm seeing is that the TradFi world is starting to launch more and more things on chain. For example, the Fidelity International tokenized fund that was launched last week, that's something that got put together pretty quickly for the TradFi world, like relative to how long it usually takes. So I'm seeing an acceleration.
Franklin Templeton has one of the most flagship RWA projects on the planet, Benji, which is our on-chain U.S. government money fund, registered in the United States, a public security that uses public blockchains as part of the ecosystem that backs Benji itself. Clients can go to Benji Invest, download our app, and be able to experience owning a digitally native asset inside of a money market fund, inside of a digital wallet experience. The tokenization of money funds, there's real world use cases and using money funds as collateral. When you tokenize them and you're more easily able to transfer those assets in a blockchain environment, that's a real use case for collateral management.
We started originating loans on blockchain back in 2018. We did the first warehouse that year, did the first securitization in March of 2020. Last year did the first AAA rated securitizations. And so we've done, at this point, over $30 billion of transactions recorded on chain. I think the provenance TVL lock value is somewhere around $12 billion right now of RWA. But that vertical was very specific to institutions. It was KKR, it was Apollo, it's the big institutions that are transacting in asset-backed securities and whole loan transactions and so forth. And what we really believe is the blockchain has an ability to displace everything as it relates to exchanges. And so we're thinking about, how do we get equity? How do we get fixed income? How do we expand the access to crypto and bring in a more transparent market and a more liquid market?
So our first project, which we announced earlier this year, was a Singapore dollar government bond fund that used the financial and legal structure of a age-old technology called the unit trust system, but essentially transformed a paper-based unit certificate into code. And therefore, the token that you hold in your wallet, you can take to court to say, this is my, share in the fund. Being able to do that was also endorsed by Moody's, and they gave us a AA rating for that structure. In noting the complexity and the compliance that we had with regards to making sure that what they held was what they were entitled to and what they were claiming.
I think, going back to what BlackRock launched, I think that was really exciting, I think, for everyone in the industry. But importantly, and what I think differentiates them maybe from some others is obviously it's BlackRock, right? It's a very big name, reputable asset issuer. And then in addition, the true integration, I think, of the tokens with kind of the digital asset space is a really big differentiator as well, in terms of the fact that a lot of different custodians accept the token. There's platforms such as FalconX, which are enabling the pledging of that token as collateral to borrow against. So there's obviously a very large name quality issuer behind it, but also utility. So in terms of peer-to-peer transfers and pledging as collateral and really integrating into whether it's an institution's or an individual's crypto portfolio, I think all of those things collectively are very exciting. And I'm really looking forward to kind of seeing how that grows out.
I think a great institutional roadmap starts with an experimentation that can be scaled, or a group of experimentations, and getting closer into the technology and finding the right business opportunity as well. So for institutions, it's really important not to only dip their toes into the technology, but build a business case that they can actually then try to fulfill. And if that business case works, that brings a lot of opportunity. BlackRock's Biddle Fund is a good example where it's scaled to 500 million, and there might be even more scalability available.
Maker, or now known as Sky, has announced the intention of or the launch of an RFP process to deploy about $1 billion into tokenized treasury bills. That is extremely interesting because actually it's an order of magnitude that's bigger than anything else to date, and it's starting to look. It's starting out with starting to be a size where you actually can get liquidity, you can get the economies of scale that you really need for these products to make economic sense, right? So we're moving away from having to subsidize this quite heavily and having to really think of this as a pilot to now actually the dollar amounts are starting to matter. And so I think that is really the significance, right? It's a large enough size that it actually matters, even to people in TradFi that are looking at this and are maybe still skeptical today.
The best way to basically manage the portfolio and increase its security is to tap into innovative features like tokenization. So everything, and this is, we're talking about $1 billion or more in collateral that will be allocated into the top, the winners basically of the tokenization Grand Prix. And as a result, every single project in the RWA space, like probably literally every single project in the whole world, has actually applied for this.
By now it's clear, we see the convergence of a multi-trillion-dollar opportunity with increasing urgency, momentum, and a favorable macroeconomic factors. So what's the holdup? What might institutions still be hesitant about?
I think one of the big points is still, or unknowns is still regulation. So today we're still kind of mostly operating around exemptions, right? Kind of like weird carve-outs or very specific regulation in certain jurisdictions. If we can get to a point where the SEC will approve a public fund to be tokenized and actually be sold on chain, that is a place where like it will be there will be a very clear low risk way for a large financial institution to actually do this, and that's really what's needed going forward.
I think the regulatory environment is challenging, in part because the regulators don't have legislation to regulate to, and that introduces a lot of subjectivity as to what is a security, what's a commodity, who regulates what. But I think we should be pragmatic that it's not necessarily that much better anywhere else. I think all regulators globally are struggling with what is a significant change to the way we thought about securities and security trading and commodity trading historically.
So regulation, I think, is by and large the largest issue today. And I think that's also where traditional financial institutions have a natural advantage, is they have an effective monopoly through regulation on issuance, distribution, custody, some of these other really critical functions. This is again why I think creating net new assets that cater towards things you can uniquely do on chain is a great application of real world assets, because it's a place where traditional financial institutions don't have a regulatory moat, where they can't compete, and when there's still enough ambiguity to get to too big to fail scale like Tether has, right?
I think if you work in this space, regulation and policy is super sexy because you know it touches every part of your business, even if you're not exactly sure how. I think that there are different types of regulatory regimes that are popping up all over the world. You have the markets and crypto assets regulation, which really looks to centralized actors and centralized issuers. So really thinking about something like tokenized assets in the EU, but also we have draft legislation that just came out of the House that's meant to be a very comprehensive market structure bill in the United States. Japan, Singapore, tons of countries around the world are really trying to figure out this question. So I think as we see this emerge, finding ways to move this cross-border or borderless type of technology, thinking about how to harmonize regulation and make it all work is really sexy and interesting. I think that's really the most exciting thing, is to see the technology developed around some of the policy goals.
But you'll find that there are some hubs that tend to attract a lot more of these players in. And usually it boils down to two things, right? One is really a government policy that somehow is open to experimenting with this area. Right? Yes, there will be risk, but if you don't try to understand the product by sort of first telling the world that I'm prepared to work with you, it's going to be very hard for you to come up with the appropriate rules and regulations, right? So first and foremost, I think the UAE government has put out a strong statement to say that we are open for business. And the second thing is, with that collaboration with the industry, we recognize the importance of having to put in place regulatory requirements that are best in class and aligned with international standards.
You know, the idea that a regulator like the SEC can observe the activity that's happening in Benji by accessing the explorers from the various public chains that we use is an increased level of transparency that the SEC has not yet had as it relates to kind of the traditional transfer agency process. So this idea that blockchains provide new and interesting feature sets for all stakeholders is super, super important.
The most important factor is that governments and regulators around the world recognize it is not going away. So I think in this respect, what I'm seeing right now is that everyone acknowledges that real world assets, cryptocurrency, these are things that will be of the future. These are things that are present, future, and is here to stay.
We've seen the potential of tokenization and the hurdles that still stand in the way, but we haven't yet addressed one of the largest inhibitors of growth. Where will the demand for tokenized assets come from? With supply outpacing demand, the focus shifts to unlocking liquidity, aligning with investor priorities, and proving that the value of tokenization lies beyond its novelty. So, will growth be driven by established assets like treasuries and private credit, or by unlocking previously illiquid high-value assets? Let's find out.
Real-world assets in asset management have started, in one of the most plain vanilla products, money market funds, where they've already had a lot of take-up, right? Because there's a need for on-chain yield, so not just holding in a stable coin where you get access to the US dollars, but you're missing out on, the 5% yield. That said, I'm excited for what it can bring to the private market space, and this more illiquid part, but also one of the most actively, rapidly growing and expanding parts of the asset management universe.
You haven't seen what I would describe as like meaningful product market fit in that long tail. But I think we're going to get there. I think some of these things just take time. I think it'll happen in like pockets. Like maybe it's carbon credits that have, or maybe it's, tokenized art. Or maybe it's like tokenized like compute, right? There are like different interesting categories. And I think like different categories will achieve that escape velocity at different points in time. I think like the first long tail tokenized asset will achieve like meaningful penetration by, I think in the next 3 years.
So the thing that stands out to me continually and will gain, in my opinion, the most traction in the coming years is real estate. There's going to be so much data on the blockchain that the blockchain is absorbing that property management, property owners around the world will have a much clearer understanding. The tokenization of real world assets could create a liquid structure where we could eventually trade everything. So just imagine a family, they could tokenize their house, put it up on the capital markets, and they could trade it very quickly.
The number one thing that investors need to see are additional use cases from tokenized assets. The thing that separates RWAs from traditional off-chain assets is what they can do. And as the use cases increase, the demand from investors will as well.
I think we'll still see a lot of financial assets coming on chain, right? Because those relatively well defined. So funds, like blue chip funds from asset managers that may not be available everywhere and then become more widely available. Private credit is also kind of having a moment as well. So I'm seeing some very interesting platforms there. I guess one of the promises of asset tokenization is that you don't have to limit yourself to public markets. Now you can go into private markets that may be offering higher yields, but that were not necessarily available to a large tranche of investors, and now they're able to have a broader reach. So I think that's quite interesting as well.
We'll see demand move on from just treasury bills and kind of similar instrument money market, like let's say treasury bill ETFs like products, into other assets up the curve. So longer duration, slightly longer duration, slightly higher risk, but then also better return profiles, right?
We have to see people building for the demand, and we have to see the demand materialize. I think it is that. It's really the founders evangelizing and making it clear around why these things are better and building the products that these people want.
Real-world assets are no longer just an idea. They're a movement, gaining real traction. Capital is flowing in, new use cases are emerging, and institutions are inching closer to widespread adoption. But for tokenization to reach its full potential, a few key pieces still need to fall into place. We asked industry experts what's missing, what's changing, and what excites them most about the future of real-world assets. But what we found was striking, just how fast the missing pieces are coming together.
I think the biggest friction here is behavioral change. It takes a long time for humans to learn new behaviors. When the iPhone first came out, there wasn't much you could do with an iPhone. And now, 20 years later, right, we have smartphones that are effectively supercomputers. And so I think one of the biggest things that needs to change that we can't force, I think in crypto, we have this desire to accelerate the rate of change at all times, but there's a fundamental limit to how fast societies can absorb and integrate new technologies.
It's really just time. As more time passes, as more people lean in and participate, as we get past the bankruptcies of 22 and the ridiculousness of that period, let's hope we don't go back into that ridiculousness or set ourselves back another decade. When they see real application, real economics, and real participants, more people will crowd in and it'll support itself.
Finance is complex and old and regulated and like many different parties involved. So I think it's normal that this stuff takes time. Are we doing enough? We're doing everything we can, and I think it's going to lead to a lot of exciting stuff.
So you'll see institutions bringing more products on chain. You're going to see new businesses being built to offer wealth management solutions. And what you're going to start to see is this emerging category of fintechs, wealth management, asset management, positioning itself on chain to offer those products and services to the investor community who are now operating on Web3, on blockchain rails.
So I love, what these entrepreneurs are able to bring. And, beyond bringing efficiencies to the existing system, think about just a whole new range of assets and products that can be traded, managed, etc. So when I think about what's exciting, yes, the incremental innovation and efficiencies are really real, and I think it's what's going to convince traditional finance to get on board. But if we can do things that we haven't been able to do before because of tokenization, that's cool.
The thing that excites me the most is unlocking more deeper, substantial investment opportunities for clients themselves. The idea that maybe half of the assets on this planet Earth are accessible through private and public markets currently, but half of those assets still remain not fungible or in a place that investors can weave them into the portfolios in order to increase the possibilities of generating better outcomes. That's the thing that's most exciting for me. The idea of always trying to find interesting investments that combine with the client's other assets to create better outcomes. That's the most exciting thing that I think about tokenization and RWA.
I mean, what excites me the most is the fact that we are getting this traction, there's momentum, it's going to grow. And to me personally, this is really, the start of really the Web3 for finance becoming a reality, right? You're never going to have an environment where it's all DeFi, and you're never going to have an environment where it's all TradFi. These two coming together, so using the DeFi type technology into the traditional assets under management, that's what it's all about, right? So to me, that is what's exciting about next year. I think it's really going to take off.
The financial world is changing. Traditional assets like real estate and private equity are being transformed into digital shares anyone can trade. This isn't just making old systems faster, it's creating entirely new ways to invest and build wealth. For the first time, investors of any size can access premium investments that were once reserved for only the select few. Banks and asset managers are discovering they can turn slow, expensive processes into efficient digital operations. Major institutions are already building these systems, and regulators are creating frameworks to support them. We're witnessing a fundamental shift in how value moves around the world, and it's happening now. So the only question is, are you ready?